a big warm welcome. Thank you very much for joining me. My name is Adam from Trade with Precision, and today's topic is trading fundamentals, 12 critical techniques for new traders. What I am just wanting to do very quickly is just confirm from my colleagues who are watching that the stream is working correctly, because we are streaming at the same time, and that you can hear me. So it should all be good. It looks good on my side. Everything seems to be working well. For those of you in GoToWebinar, I would love for this to be as interactive as possible. So please feel free to ask questions. Just type into the questions box. I'll have the questions box open. Fantastic. I will have the questions box all open, and then if you do have any, I will just answer those as we go. I'll make it, I'll do it in real time. So don't be shy. You don't have to wait till the end. As soon as you have a question, just great. Thank you very much for doing that. Just ask away. So the reason it's a little bit different for me, we've moved to a new house by the coast. So we arrived yesterday. So today I'm setting up, and you could see very quickly, you can see the entire house is still being unpacked and very, very spacious. We've gone from a smaller house in the city of London to a very big house in the countryside, well, near the coast. We're like 10 minutes from the beach. So let's have a look, see if there's any issues. Fantastic. Thank you very much for confirming that. So I'm just adjusting, which is this morning. I'm like trying to get the Wi-Fi up, and we've got Starlink, which is Musk's new. There's literally a satellite dish out there that you install, and you've got Wi-Fi. So anyway, that's not that any of you care about that, but it's an interesting exercise to go through. So thank you very much for joining me. So today's topic is 12 critical techniques for new traders. What I would like to do is to give you a moment to digest the risk disclaimer before we kick off. So, and while you do that, I'm going to tell you a little bit about myself. I would have said that I'm a trader based in the city of London. However, I'm about an hour out from London now. I'm right near the cliffs of Dover, so very close to the sort of closest point connecting to France. So if we want to get on the ferry, it's probably about 20 minutes drive to get to the ferry to go across to the coast. I am both a day trader, so often I'll be up for either the morning session, which is when the UK overlaps with the tail end of the Asia session, and there's usually a nice little boost of volume, looking to take trades on the 1 minute, the 5 minutes, or the 15 minutes. So the reason we do that as day traders is we're really looking to make sure that our trades are ideally closed within a day. So even if I get in on the 5 minutes, it is possible that if the market acts up a little bit, you might take half the day to close that trade out. So we're usually looking for very much lower timeframes to give our trade an hour or two to close out. Sometimes it closes out in 10 minutes, sometimes it closes out 90 minutes later. I also will look at the US session. So sometimes I'm waiting for a setup in the morning that doesn't occur, doesn't set up, and it then moves across to the US session, which is usually in the afternoon. And then at about 6 o'clock in the evening, so it's usually about an hour, 90 minutes in the morning, an hour, 90 minutes in the US session, and then usually looking for about 30 minutes, 6, 7 o'clock in the evening, looking at the daily chart, looking for setups on the daily time frame. And the reason for that is that often there can be really good setups that are almost taken on a much sort of something that might take a few hours, something might take a few days on the daily setup. And often it allows me a lot more flexibility in terms of my day. So for example, yesterday we were moving, today we're unpacking. It allows me to say, okay, I'm not going to trade the US session today. I'm going to look at the daily chart. So the timeframes and the directions tend to be largely the same. And I just want to describe this to you because a lot of people are not really sure which kind of trading style will suit them. I trade with the trend, and I trade every single market that's moving. So if you're focusing on a trend, if you're focusing on the right types of conditions, then you can look at more markets. Okay, as opposed to kind of look at euro dollar and going, okay, well, which way should I trade? Often if I just go, I'm looking for a strong trend to the upside or to the downside, then actually you'll find that all of a sudden the 30, 40 charts that you normally have to look through reduces down to about 5 or 6 charts. Okay, that's more than enough for me you don't really need or care necessarily about any of that kind of thing. Okay, so this is part of the Trading Fundamentals, the series. These webinars are designed to take you through all the core and sort of using the word fundamental things that you do need to be aware of, and to get you to a place where you understand these are all the different things, ingredients that you need to get you to a place where you can start practicing trading. And one of the things I would say to you is trading is very similar to learning a new language, or to learning a professional sport, or to Learning a musical instrument. It is something that we can do, but one of the things that it requires is a mastery of the basics and practice. That's it. Mastery of the basics and practice. And that is something that I don't think we talk enough about, is that we are basically, every single trade we take forever is always practice. Even once you become a professional at a particular sport, you still need to train, you still need to practice, you can still lose your technique a bit here and there, you can get the yips, you can get all kinds of things. It's very, very similar. Psychology comes into it as well. Okay, but practice, if you understand that every trade you take is practicing for the next one, it actually will help you tremendously. So on the agenda today, we're going to talk about asset class exploration. We will highlight the relative merits of different asset classes offered, such as Forex and gold, share CFDs and cryptos, and look at risk, liquidity, diversification, benefits, and alignment with different trading goals. There are different ways of making money in the markets, but what I would say is this, is that for retail traders, which is where we fit into, so if you're not a massive institution or a bank, you generally will fall, if you're a private individual, even if you're a high net worth individual, you fall under the classification of retail trading. So we are effectively just another type of market. You get institutional trading, you'll get different types of trading categories. We fit into retail trading. And I would say that there are a limited number of ways in which retail traders can engage in the financial markets. So next time you hear someone say, look, there's an unlimited number of ways of making money in the markets, not really strictly speaking for retail traders. We make up a big chunk of the market now. It used to be less than 5% just 15 years ago. Now we make up about 20-25% of the market. We are a bigger contributor to it. But there's not an unlimited number of ways in which we can access the markets and engage in it, but that's not a problem. We can still do. I might just turn off my webcams potentially if we'll just do it for now, but if the connection slows, because I'm uploading is a bit slower, I'll switch off the webcams. So the point is that they aren't necessarily. We usually have to have a particular technique. We usually want to trade with the trend or against the trend or in a range. That kind of pretty much sums up, and that won't depend on which instrument we're trading or which time frame. It's basically will be the type of market conditions that we will look for trading opportunities. We will tend to have a stop loss and take profit technique. So there's a few hundred different ways of doing it, but that's it. And I want you to know that, because I want you to understand that although you do have a lot of choices, a lot of them often become very much just variations on the same idea. Okay, so trading psychology, exploring the psychological challenges that traders face and the strategies to overcome them. Discover how mastering your emotions and maintaining discipline are key to achieving lasting success in trading. So if I may, I'm going to oversimplify it a little bit here. But our trading psychology, our sense of self-worth, our sense of how well we think we can do in anything, in any endeavor, all of these things are actually largely the same with most people, believe it or not, with most people. I have met thousands of traders. I have mentored thousands of traders over the last 15 years. And I would say that almost all of them had the same difficulties, the same problems, the same concerns, the same fears, and made the same mistakes. So just for now, let's assume that everybody is pretty much the same. I know of 2 people that picked it up relatively quickly out of thousands of people. So I think it's fair to say that every single person has the same problems and takes the same amount of time to basically find their groove. And usually finding their groove comes from settling into the types of market conditions they can learn how to identify. And once they've learned how to identify them, they get pretty good at identifying entries, stop loss placements, and a fixed set of rules to where to put your stop loss and where to take profits. That's it's an oversimplification, but it's pretty true. The reason I bring that up is that our psychologies are also very similar. That kind of imposter syndrome and fear and greed, all those kind of things are very much built into every single human being. They're pretty much the same. Usually the people who get out the other side of that learning patch, really good instructors or mentor or stuck with it long enough, even working on them, just stuck with it until long enough that even if they were making stuck until they overcame those. But you don't have to go through as much difficulty if you have good education. That's just how it is. So trading psychology and risk management, which is the next component here, which is discovering the paramount importance of a comprehensive risk management strategy, including mastering the risk to reward ratio, tailoring position sizes to your risk tolerance and account size, and leveraging diversification techniques to mitigate risk. The only word that isn't included in there, it's not a complaint or a criticism, but it's a long sentence. The only word that isn't included in there is probabilities. So when, for example, all of this is really understanding that we are trading in probabilities. If, for example, I'm standing in my driveway and there's a basketball hoop, and I'm standing a certain distance away from the basketball hoop, I've just installed it, I've never done this before, I'm really excited to learn how to do this. You can imagine that it's going to take me a while to be able to confidently throw that ball through the hoop. And it's going to take me hours of practice. Sometimes it's going to be fun. Sometimes it's going to be frustrating. Sometimes I'm going to feel like I'm never going to get it right. Sometimes I'm going to feel like I've nailed it. And there's this whole journey that you go on, which is emotional, psychological, various other things. Now imagine that every time you got it through the hoop, now logically it makes sense that in the beginning, if you haven't done it before, you're not going to be as good at getting that ball through the hoop. But with practice, it's almost a certainty. You'll get to a point where you can turn around, you won't even look, you'll just throw it, it'll go through the hoop. You become so good and so familiar with the technique and your judgment and your familiarity with the surroundings that you nail it, you are in the zone. But now imagine that I say to you, well, I'll tell you what, every time you throw it through the hoop from day one, you're going to get $100, for example. But every time you miss, we're going to take $100 from you. So naturally, in the beginning, you're going to lose a lot more money because you're just not necessarily going to have that technique. So you're going to lose $100 way more often than you make $100. And the problem with that is that after a while, that's going to hurt your actual wallet, which is going to mess with your head. So the fact that you're losing money, you might be down like $2,000 or something ridiculous. And after that, you're like, maybe I should just stop doing this because I'm not going to make any money. So what's happened now is the fact that we've attached money to it has changed your mindset. It's changed the whole experience for you. And that's the same in this particular case. With trading and risk management, the two things that are really part of each other, and the probabilities aspect that I mentioned earlier. Probabilities is the likelihood of success. In the beginning, our judgment and our skill and our experience is nothing. Therefore, our ability to be successful and have the probabilities of success on our side is not really there. It's not really there. But with practice and experience, after a while, we start to win. In other words, the probabilities of us having a winning shot starts to act in our favor. Then we start making more money. So the secret here, really, and this is a massive, massive tip, this is a golden goose type tip, or at least a goose that lays golden eggs type tip, is that keeping our money small in the beginning so that our focus is on the practice to get through that no experience, no skills kind of phase is really the secret. If we dial up the money too much in the beginning, we're going to do so much damage to ourselves financially before we've developed any skills or any experience. So if you want to get to that place, ironically, you get there faster by keeping the money small in the beginning. That's less than 1% per trade, 0.1%, 0.25%, 0.2%, a quarter of a percent, small amounts, because your focus shouldn't be on the money, your focus should be on the technique. And then the probabilities, because the probabilities are generally the same for the strategy, but our experience, if we have no experience, we make lots of mistakes. We mess up the strategy. We don't calculate that. We don't execute the recipe as well because we just make mistakes. So, asset class exploration. The financial markets are home to several asset classes that meet the needs of various market participants. For example, some traders employ momentum strategies which require assets that demonstrate a reliable trend. So for those of you who are very new to this, the language, the words that are used can sometimes make everything sound super complicated. Trading is simple conceptually. It's actually a very simple exercise conceptually. But in terms of execution and doing it, there's so much that goes into that that it's actually a nuance that it becomes complicated. So I'm just trying to, basically what happens is that as you become more experienced, you don't require as many indicators. You don't require as much concentration because your brain has become experienced and you can read it better. So I just want you to understand that, but conceptually it's relatively simple. So the program we're doing here is to talk to you about the concepts. Once you master the concepts, then you will start to improve your confidence. And confidence is a really big component of this. We cannot really trade if we trade well, if we're distracted. Doesn't matter how long you've been doing it for. If you're having a bad day, it's going to mess with your trading. So when I say things like momentum strategies and requiring assets that demonstrate reliable, those big words, don't worry, all of that stuff, that pretty much stays the same. Those words stay the same, and the concepts that they are built around are not really super complicated. So conversely, some traders will seek low risk, predictable returns, and they prefer assets that limit portfolio volatility. Again, it's really big, I want to say convoluted language. It's not really. We pretty much only talk about certain things when it comes to trading. We talk about risk, we talk about returns, we talk about assets, which are instrument classes. So an asset would be something such as gold or property, or maybe currencies such as euro, dollar, or cryptocurrencies, for example, or stocks. Those are different types of assets and asset classes. And when we talk about portfolio volatility, now volatility, this is a great example of how language in this industry doesn't necessarily help with certain situations. Volatility actually has two different meanings within investing and trading. All right, so volatility basically means volatile, it means violence, it means choppy. And so when we talk about the markets being very or extremely volatile, naturally what it means is that we are talking about the markets are just too choppy, too stormy, and much more unpredictable and becoming potentially dangerous for everyone to engage in. However, volatility is like a volume dial. There's the volatility at its most basic level, it means movement. So we need the markets to have some volatility. If they have zero volatility, they don't do anything. It's like they're in a coma. It's like you want to go surfing out in the ocean and waves. The ocean is flat as a mirror. It's like glass. There's nothing happening. So you can't do anything because your whole purpose of making money is you need waves. You need to be able to get on a wave in the market and ride that wave. So zero volatility is a bad thing for us. Extreme volatility would be like a storm where the waves are 30 feet high and it's just too dangerous for even professional surfers to go out. And I shouldn't say 30 feet high, I mean like 50 feet high. So we need some volatility in the markets, but extreme volatility is dangerous. When they say limit portfolio volatility, what they really mean is that we want to make sure that we're not caught up when there is potentially a storm happening in one particular asset class. Maybe there's a bear market, or the euro or the currencies, maybe there's an election happening and the market is just extremely volatile. So when you want to make sure that we have avoided that, or we reduce our exposure to that. So, excuse me. FX pairs often move in small increments, so they may be more suitable for traders with lower risk tolerances. So when you hear about leverage and margin, what makes Forex so attractive is that it's a relatively new market. It's only been around for retail traders for 20 years. I mean, it was really, although the FX market was kind of created around mid-1970s between banks, that's when it sort of was birthed. It wasn't even really available to sort of brokers per se until 97. Until 1997, I was probably 22, 23 then. I mean, I know I don't look that old to you, but, or I do either way. But so it's not really been around. And even when I got started in trading in 2008, 2009, which is not that long ago, guys, currencies were still relatively new. Cryptos weren't even remotely available. Okay, so cryptos really only became a viable trading asset about 4 or 5 years ago, just like prior to quarantine lockdown. Really, it's, although they have been around and people have been talking about it, they weren't liquid enough, they weren't really available through enough brokers. So they're still a very new market. So I want to just try to explain to you how new some of these markets are, whereas stocks have been around for hundreds of years. Okay, and the Dow was, kicked off in 1896 by Charles Dow. So that's been around a lot longer. So you need to understand that. But the beauty of FX currencies is that they are traded 5.5 days a week. So from Sunday night through till Friday night. It's much larger liquidity. Okay, it's a much larger market cap. right? Your average currency, sterling on its own, is more liquid than the most liquid stock that exists, more than Apple, for example. So very, very liquid, and they move in very small amounts, which allows brokers to offer people that ability to get into the market to trade. And in order for us to make money, we must imagine if only, again, 1% of the population could access a particular market and nobody else could, because you had to have like $1 billion to get in. So the whole point of this is that markets and brokers, and this is a good thing, tries to make sure that the average person can get access to a market. And so they do that through leverage, and margin is your deposit on a trade, but leverage is what allows us to do that. And FX is great for better leverage, or a sort of larger leverage. It just is. Gold is often more volatile and susceptible to the movement of real interest rates and the US dollar. Therefore, it falls more toward the middle of the risk spectrum. One of the things I want to clarify here very quickly, a lot of people get this idea in their head that gold is a hedge against inflation. That is actually not the case. That's just one of those urban myths that just everybody believes that actually isn't the case. When we had worldwide inflation, gold actually dropped. And the reason why it dropped was because of the US dollar. So as per this paragraph here, which says that it's susceptible to movements of the US dollar, that is correct. All right, so the first thing you need to understand is that there are way more things that will move the price of gold other than inflation. Inflation is right at the bottom of the list. Okay, just make sure that everybody understands that. It really is not a key factor with gold. CFDs of individual shares are often more volatile than gold because stocks incur market risk and company-specific risk. So CFDs just stands for contracts for daily. It is just the name given for the types of, it's old-fashioned types of contracts that allows people to get in and out of the market with stocks. Because usually you would buy and hold the actual shares of stocks, but then they discovered with day trading, a lot of day traders didn't necessarily want to go through the complicated process of buying the stocks and selling them, so they came up with something called contracts for daily, which really means you could get in and out with ease. It's just a fee that you pay, and you can piggyback on the movement of a particular stock, such as Apple or Tesla, and do it. Now it's all done electronically. So when we hit buy or sell, it is automatically getting us in and out and basically executing the CFDs. So when you hear about a broker offering CFDs, that's really what they're doing. They're just offering you access to stocks, for example, so that you can trade on top of those, the movements on top of them. That's all. And then finally, cryptocurrencies often produce the highest volatility as they are relatively youthful assets with smaller market capitalizations, and less liquidity. Everything that has been said here is true and really worthwhile keeping in mind. All right. Now, depending on your preferred style, traders confront psychological challenges such as mental fatigue, emotional instability, regret, and boredom. These are all normal, what we call universal experiences. These are normal emotions that we can feel, and it takes a long time to master those. It takes practice. There'll be days when we are more susceptible to being grumpy and ratty and emotional than other days. Other days we are just more bulletproof to it. So, but over time with practice, we become more neutral, emotionally neutral. One of the beautiful benefits of becoming a trader is that you learn to master your emotions, which you can do in other things in life. You can go into martial arts and karate or taekwondo or judo or whatever, and they teach you how to master your state of mind and master your emotions. And fighting is boxing, for example, MMA is a really great way to teach you how to not become emotional, not to become angry, because when you do that, you tend to make mistakes. So these are types of skills that we can learn in other parts of life that we can bring through to trading. But it's interesting, sometimes we still have to learn how to do it within this, because money and our idea of self-worth and how much we deserve and attaching all our hopes and dreams to money makes trading itself incredibly emotional. But for that particular reason, we have to learn how to disconnect that. And that is not easy for anyone to do. It takes time. Okay, the amount of time depends on the individual and their training and their education, but it takes time. So these weaknesses often precede poor trading decisions, which impairs our profitability and limits our chances of longer term success. If we cannot over time eventually master our emotions, then and change our behaviors, we're always going to make mistakes. So for example, if we have a losing trade, which was a great trade setup, but it was a statistical loser, but we get angry and then we decide to revenge trade. So now we're going to teach the market something. That's like surfing in the ocean, getting dumped by a wave, and then deciding to punch the ocean. Okay, it's not going to do anything. It really doesn't help us at all. And the problem is everything we do becomes a habit. So if we start revenge trading, that becomes a habit. Then we continue to revenge trade every time things go badly for us. And there has never been a successful trader that made money that way. So the best course of action is to systematize your approach and only trade when predetermined milestones are met. Okay, so you have a set of rules that describe a particular type of setup, like a head and shoulders pattern, which is a very successful pattern, or a double bottom or a double top, for example, or a bull flag or a bear flag. These are just general techniques that do exist out there. You learn how to identify them and you learn how to trade them, where to put your entry, where to put your stop loss, where to take profits, and then you let probabilities play out. Hopefully that makes sense. We want to overcome emotion by determining a set of rules that define our trading. All right, so for example, you can set a minimum reward to risk to reward ratio, it doesn't matter which way you say it, required for execution, and only trade when the setups meet our criteria. So let's just say, I'll use that example of a head and shoulders pattern. If you're not familiar with that, you could Google it. Head and shoulders pattern, which is a change in trend from an uptrend to a downtrend. They have they actually specifically have an 83.04% chance of success, meaning that about just under 17% of those trades out of every 100 we take, just around 17 will be losing trade setups. Which ones we don't know. Which will it be? The 16th trade, the 23rd trade, we don't know. But 80+% of those will be winning trades. All right. And they have a risk to reward or reward to risk of 1-to-1. Now, when unlucky events occur, don't double down on a position out of frustration. Instead, stick to your predetermined stop loss level and wait for the next attractive setup. And this is why we have to let the numbers play out. So if we are only focusing on head and shoulders, we have to have our stop loss in a specific place. And if that stop loss gets hit and it is in the correct place, then that was potentially one of our statistical losing trades, assuming we've identified a valid setup. Then then we know we just have to go through 100 of those trades and we will have way more winning trades than losing trades. So all traders have losing trades. Sure, as you get more experience, you have fewer losing trades and you handle them better, but you can't eliminate them. No one can. So we want to stay mentally sharp by not over trading. So let me tell you this. So for example, I'm probably really, in terms of mental efforts, probably an hour, 90 minutes in a day of really hard focus or whatever, but it gets less and less. But we suffer from emotional and mental decline or cognitive decline if we concentrate for too long. So we shouldn't be actively trading for 5 hours a day. It's too much, probably 2 hours a day. But also in the beginning, you want to be learning stuff. So you need to be, back testing or reading books or focusing on your strategy, mastering that. But actual trading, probably 2 hours a day. It might be spread out over the day. It might be just in the one session, in the morning session or the US session, or you might be looking at the evening session on the daily chart, or it might be spread out. You might be doing bits and pieces like I did. A respect for risk management is the most important characteristic inherent in professional traders. Again, I spoke about probabilities. All right, risk management basically says, I know that I'm going to have losing trades out of every 100 trades, but I want to make sure that those losing trades don't blow my account. Obviously, I want to make more money from my winning trades than I do from my losing trades, and that's what the risk management really is for. It's making sure that every single trade has a cap, a maximum loss that can be incurred. They understand the longevity depends on preventing significant drawdowns of our portfolios. Part of the reason why it's so clever to start off in your first 100 trades while you're mastering your strategy to keep your risk down at 0.1%, 0.2%, is that it allows you to take have 20 losing trades when you don't really know what you're doing and not do too much damage to your account. Excuse me, I handle large amounts of money, so not ridiculous amounts, but it varies between 10 and 20 million for clients, and a smaller portion of that for myself. And psychologically, my sweet spot is about 0.5% maximum exposure per trade, but I might take 7 or 8 trades. So that means that at any one time, I've probably, in realistic terms, probably got about 3% exposed. And it's very rare for all of that stuff to go south. It's very rare. Almost always I'll be break even or up on the day, but I will have losing trades. But a 0.5% loss or less, maybe 1/4% loss per trade or whatever, it's okay with me. I don't mind that. It doesn't feel like too much. And then it adds up. So you only have to make something ridiculous like just under 0.29% per day. If you could, if there was a way for you to make 0.29% per day in your accounts, it would compound to 6% a month, and 6% a month would compound to 100% a year. So just my point here being that it's really small amounts. You don't have to kill yourself to get large amounts every day. What you really want to do is to try to just get fixed amounts as often as possible into your account to allow the compounding to take effect. Okay. And to give you kind of a frame of reference, I mean, I delivered 40% to my clients over the last year. I was hoping it would be 60%, which is amazing, but it was 39.9% or something. It was basically 40%. And I think it should have been higher, 60 to 65%. But that was fine. It was still really, really good. And it was a great year of trading. It was very little stress for me, and relatively easy to do. And I think every year will get better because I will get better. Okay, so to give you kind of some figures there to work with, and that actually didn't work out to 6% a month. I had some months where I actually had drawdown, which messed with the whole 6% month per month thing. And you can't trade December anyway, it's a joke. So, all right. To master this mantra, you should prioritize minimizing losses over realizing gains. What does that mean? It really means that, first of all, you want to make sure every trade you take in the beginning has the potential to be a losing trade. So you want to cap how much that can be. You do want to decide where to put your stop loss, putting your stop loss above or below a support resistance level, so that if the market does go there, it's definitely not going to go in your favor. Those are the kind of things that they want you to focus on. And then definitely, ladies and gentlemen, please listen to this thing that I'm about to say now. You really, 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 really need to, for trading, not investing. So investing is a buy and hold for very long periods of time. If you're trading, every trade you take must have an exit plan. So before you get in, you have a plan to close out that trade. And this is a big thing. A lot of people confuse the two, and that's okay because nobody's telling them not to. But every trade has a stop loss, an entry, and an exit. And that exit could be a combination of things. So it could be a trailing stop loss, or it could be taking partial profits, or it could be hitting a target, or it could be all three. You could have a target set, and if price shoots there very quickly, you'll close out the trade. And if price goes up and doesn't hit your take profit, but then comes back down, your trailing stop can catch it. But every trade must have an exit point. I know so many traders that pick good setups. The setups trigger, they're in the money, and they just don't take profits. And eventually it comes back and hits their stop loss because they got this silly idea in their head that they were going to just ride it forever, not understanding that currencies can go one way for a day and then another for another day. And trends don't just last forever. So you always assume that the market is going to come back on you and you take profits. You can always get back in again, and the best part about getting back in again, if your setup is valid, is compounding. So you're going to make more money the second time around anyway. All right. So diligent risk management begins by calculating your risk to reward ratio. The statistic determines your maximum gain, maximum loss, and when specific prices require you to exit a position. So I'm going to show you something. I'm going to draw something here so that we can see this. I'll go with yellow, which should work. Yellow. Okay, so let's imagine that there's a price level here, a support resistance level here, and a support resistance level here. So the market comes up, bumps its head, tries again, bumps its head, then it manages to break through, comes back to retest this, and we get a beautiful bullish candle there. So the market is really about price levels. It works from one major horizontal level or pivot level to another, kind of generally. So imagine now that it's broken through this, statistically, the next most likely place it's going to get to is up here. So I want to, ideally, if I think I can get out of that, I want to take profit just ahead of this level. I want to be smart. I want to take my profit just ahead of that level. It's a really clever, because sometimes price levels are not exactly precise. So just to avoid the market turning around, maybe coming back down, I want to make sure I take some profit before that. Now this level of resistance will probably turn out to be support. I don't know that just yet, but so I want to put my stop loss here. So I can put my stop loss here. That's one area. So my plan is to get in above the high of this bullish candle, because we are in an uptrend. It's broken through this level. It's retested this level. Maybe there's even a moving average going over here. So maybe I've got moving averages. There might even be a trend line there. There's a whole lot of different things that tell me this is trending higher, and this is a really good place for it to come back, retest, and take off. Now, the thing is, it could just take off like this and go straight up, or it might sort of do movements like this. I don't know which way it's going to go. You don't know that. So once you're in the trade, you have to let probabilities play out. So I want to put my entry above the high, excuse me, of that, beg your pardon for coughing in your ears, above the high, that bullish candle. Now I can put my stop loss here. That is a very valid place to put it. It's below this level of resistance and potentially stop loss. I could also put my stop loss below here. So those are two valid places. Both are valid. They have consequences. So with a tighter stop loss, my one-to-one target is closer. So if that's my entry and that's my stop loss, then that becomes my R1, that becomes R2, that becomes R3, maybe R4. So R4 means risk to reward 4 times, okay? So that means if my stop loss is here, I risk 1%, the potential profit is 4R or 4%. Okay, if I put my stop loss here, then my one-to-one is probably here, and I might just get 2-to-1 out of that. So the further away my stop loss, the further the market has to go to give me returns. Now, ironically, those two, the probabilities of price going up kind of stays the same no matter where my stop loss is. The market is either going to go up to that level or not. This is a nice healthy or not. Probabilities, if this is a nice healthy, nothing's going to stop it. The probabilities actually remain the same, generally speaking, whether I put my stop loss here or here. However, if my stop loss is too close and the market wobbles a bit, I'll get stopped out. So I can have a losing trade even if I'm right about the direction of the market. Ladies and gentlemen, pay attention to this part. So I can have a losing trade, even the market could trigger me in, hit my stop loss and keep going. And that's incredibly frustrating. That can happen. If my stop loss is wider, further away, it won't get hit, but I'll make slightly less profit. So you're saying, well, what do I do? Well, the truth is that generally there will be 1 or 2 places to put your stop loss, and your goal as a master trader, in other words, the type of trader you want to be in the future, who's enjoying what they're doing, making way more money than they're losing, and has great degree of confidence in what they're doing, that is your challenge. Your challenge is always going to be over multiple trades, over thousands of trades, learning where your stop loss is best suited and bringing it as close to your entry as reasonably possible without exposing it to getting tapped. And if it does get tapped and you've done it 100 times and it's only ever been tapped once, then your strategy probably still works beautifully and you accept that was just the one time where the market just wobbled a bit and hit your stop loss. Okay, so that's really the difference. So just understanding that where our stop loss is in relation to our entry generally has a big impact on what our potential profit is on the same move in the market, So I wanted to show you that. So usually, then the next candle might then trigger me in, and then the market starts to work its way up. Now, what can happen? Sometimes the market comes down again, creates another bullish candle, and just low enough that it hits my stop loss. This happens. So, and then it's a bullish setup. So in isolation, that's actually another setup. I'm willing to take that trade again, my entry here. This time I'll put my stop loss below that and I'll take profit as I go. But I'm definitely going to close out the trade by the time we get to that next level. Excuse me. Now this is called a double bottom. That's a double bottom in an uptrend. So it doesn't matter whether you get a double bottom in a downtrend or double bottom in an uptrend. It is generally a bullish signal, and sometimes that happens, guys. You get a very good valid setup. You get triggered in, you get stopped out, then the market goes in your direction. But sometimes you get a second setup. You just take the setup. And this is why we have to learn to accept losses and to also over time learn to understand when we have good setups, because this kind of thing happens. As you get better at trading, your losses are very rarely as a result of a mistake you make. It's very rarely as a result of misreading the markets or misreading a setup. It's usually just a statistical loss. It's like, yeah, if I had taken that trade 10 times over, it wouldn't have been stopped out. Okay, they become statistical losses. But in the beginning, most of your losing trades are mistakes you make. You misread the trend, You put your stop loss too close, you fail to double check, look for news to see something that's going to disrupt you, those kinds of things. Okay. So when we talk about calculating a risk reward ratio, that's what we do. We look, there's my entry, there's my stop loss, therefore that is going to be my R1, I'll get R2, and that's the potential. It's always the potential of the trade. All right, your ability to predict the potential profit on a trade accurately improves over time. You're never going to get every single pip on a move, every single pip of a move. Nobody consistently does that, really. Nobody consistently does that. If you can get 50 to 80% of the move between any two key levels or of any move on average, you are already successful, because that's what your average. And anyone who tells you otherwise, I don't buy it. But once in a blue moon, you'll capture the exact move of a trade. You'll get it exactly right. Price will come up to that, goes out, hit your take profit on the nose, and then just reverse. That kind of stuff happens. All right. So position sizing is also paramount. Many traders only risk 1% of their portfolio on each trade. That means if a successful position gains 10%, it will generate a 0.1% return for your portfolio. What does that mean? It means that, yes, risking 1% of our portfolio, that makes 10% or 0.10, but we've made 10 times our 1%. So it's the same number, just expressed differently. Now, diversification depends on correlation analysis. This is beautiful. A lot of this stuff is really well said, and I've not seen it stated anywhere else. If I wrote a book, this is what I would put in that book. Diversification depends on correlation analysis. There are three, for example, there are three highly correlated 1% positions become a 3% position. So let's say I see a trade setup on dollar yen, and I see a setup on euro yen, and I see another setup on CAD yen. Clearly, the yen component of that is where the move is happening. So maybe the yen is weakening, and therefore it's happening across all the yen pairs, but I've got three setups at the same time. The problem is that at that point, I've actually exposed myself to all three pairs. I'm going to jump in here a little bit ahead of the slides, and I'm going to talk about from what I would do in that moment. Personally, I would take all three trades as opposed to pick the best one. Some traders will say, well, I like the CAD yen setup the most, I'll just take that one. I prefer to take my 1% or maybe 2% risk and divide it over those three setups. So I wouldn't go for the full 3% risk or full 1% each. I would reduce it, maybe 1.5% risk, and divide it over all three. In my experience, that tends to work out the best. So yeah. And therefore, it's essential to determine if assets follow in each other's footsteps. You should limit leverage until you gain confidence. Leverage enhances gains and losses, and you should only borrow money to trade once you've mastered your strategy. So historically, stocks have been 20-to-1 leverage. I'll talk about what that is in a moment. Currencies generally are between 50-to-1 and 100-to-1 leverage. And if they're 500-to-1, it's a little bit too much. But a professional trader would use 100-to-1 or 50-to-1 leverage on currencies. That's a really nice amount. So the way that I want you to think about it like this is, if you were looking to buy a home, your leverage is how much deposit, your margin and your leverage is how much deposit you would have to put down and what you could afford in terms of the value of the house. So could you afford to buy a $500,000 house? Could you afford that based on your salary, based on the interest rates and the monthly payments? That's one set of mathematical calculations. Because, for example, if you couldn't afford an $800,000 or £800,000 house on your current salary on the monthly payments, then you just can't do it. That it's too much risk. Okay, so it means you have to come down to what you can afford to do, which would be, let's say, a £380,000 apartment. So that's what you could do based maybe in your 20s, late 20s. You've got a decent salary, you're not being paid a lot, but at least you are now making money, and you can afford to buy or pay those monthly payments. Maybe it's as much as you've been paying rent as a tenant. So now you know you could definitely make those monthly payments. Okay, but then you've got the deposit. So you go to the bank and they go, look, you need to give us a 20% deposit on the value of this property. So you have to give them a 20% of the value of 380,000, for example. And that's the deposit you have to give them. And they will then put up the rest. And that's really what leverage is. So the leverage is how much they are willing to put up for the deposit you put down. It's that how many times. So for example, if it was $1 million property and you had to put down 100,000 in terms of deposit cash or margin, all right, and they put up the other 90, you could argue that that's a 10 to 1 or 9 to 1 leverage. Okay, that's basically what they're doing. They'll put up the other 90%, or 9 times that, or 9 to 1 leverage. Okay, so that's kind of how it would go. It depends on how you want to phrase it, whether it's 10 to 1 or 9 to 1. Whether you put down 1/10 and therefore it's 10 to 1, or whether you put down 1 and they put up the other 90 and then it's 9 to 1. The point is, what you put down is known as your margin, and that allows you to buy that property. All right, but you're still exposed. If that's every single penny you own, and now you can't afford the monthly payments, you're in trouble. And this is where leverage comes in. So if the leverage is lower, so if the leverage, for example, if the bank say, listen, you always have to put down 25% deposit minimum requirement, that will actually restrict how much cash you have to save up, and it will restrict how much you can afford to buy, because it means you probably can't afford, you don't have 250,000 lying around. $25,000, so you can't buy $1 million property, but maybe you do have, maybe you have 1,000 lying around, so therefore you buy 100,000. Leverage is how much your margin is on each thing, and you need to be aware of that. So that limits how many properties you can buy. It also limits how many trades you can open. If your leverage is lower, if your leverage is 20 to 1 or 10 to 1, you're not going to be able to open up a very big position trade, and you're not going to be able to open up too many trades, because every time you open up a trade, they earmark a portion of your account as margin. So basically, it's like buying multiple properties. So when your leverage is higher, when your leverage is 500,000, that's how people got into trouble in the global financial crisis. They could buy $1 million property by putting down $5,000. They could put down almost, a month's or petty cash or something like that, savings on their credit card, and buy a house, but there was no way they could afford the monthly payments when it came around. And that's how they got into trouble. So that's why now the leverage is lower. The leverage should be 100 or 50 to 1. That will limit the size of the trades you open and how many trades you can open. It's a good thing. It means that actually, if everything goes badly on a low leveraged account, your losses will be relatively small. You might only lose 10% of your account. But if your account is highly leveraged, 500 to 1, and you open up too many trades and the market swings too much, you could lose all of it or 50% of it. So understand that it's a good thing about the leverage being lower, but you also have to work around that. It limits your budget on your trades. Okay. So that's why they say you should limit leverage until you gain confidence. Your leverage should be, honestly, 50 to 1, 100 to 1 maximum, 50 to 1 if you can. 30 to 1 is what depends on the regulation. The FCA, for example, will guarantee protect a certain amount of your accounts from adverse experiences within, terms and conditions apply, but then you have to have 30 to 1 leverage. If you go 50 to 1 leverage, you bypass that. You don't get that cover because you've exposed yourself. Does that make sense? So in the next webinar, we've got a little bit of time. We've got 9 minutes. I can have a quick look at the markets. I want to have a quick look and show you where some of the opportunities should be. But in the next webinar, you're going to talk about trends, support and resistance, and candlestick charts. So let's go across to the platform. And let's have a look at what's going on with some of the markets. So let's have a look at gold. So gold right now, just because it's right there in front of me. Beautiful level of support. This is almost a bit of a double bottom. Nice bullish candle. So gold is going to try and turn around now. I will know that for sure. Just going to draw a line here. So this line is not super important. It's really just a downward trend. It just means that if price can get above that level, we know it's going to be bullish. And also we will look for price to break above here. So when price goes from a downtrend, I'm going to change my color. So I think this is trying to turn around now. The first clue will be when it starts to break above here. So probably what it'll do is try to break a bit here, then probably come back and retest this, and then come back. And definitely once it does that, it will have broken through this downward sloping trend line. It will have broken through that. It will have produced a higher low, higher high, and it will have broken above this high. And by that, the time it does that, now you know, okay, it's going up. Because here you can see it's going up. Now you can see it's going down, and now it's trying to turn around. These lows are quite important. That low, then that low, then that low. Now we have a higher low. It's trying to turn around. Okay, but you don't just buy now because you don't have enough of a confirmation of trend. So you wait for it to do a few things. And one of the things that we can wait for it to do, higher risk, is to wait for it to break through there. So you can break through there, stop loss there, stop loss there. Any of those are valid. And we're targeting up here for now. That's higher risk. Price is going to come back and bounce and set up here. So that could be a setup. So you could enter there, stop loss there, stop loss there, stop loss there. Target's still the same. So that's multiple ways of doing it. Or I could wait for it to break there, get in there, stop loss there, stop loss there. So in other words, the first thing I did was assess what I think it's likely to do, but that's experience talking. What I need to see it do to confirm that it is going to do that. And then I suddenly have a whole lot of different ways in which I can get in on that move. And that, ladies and gentlemen, is where you get to down the line. You realize which way the market's going. You realize that it has to do a bit more. It has to cook a little bit more. It's got to bake a bit more. It's not quite ready yet. But if it does a few things, then it's almost certainly going to go your way. And your earliest entries are much higher risk because it hasn't cooked enough and therefore could change direction. Once it starts to break above here, once it breaks above there, then it's almost certainly on its way back up. Okay, now let's go and have a look at a few other things here. So let's go see what's going on with this one, for example. So if we have a look at sterling, excuse me, so this is sterling, this is the pound. This is a weekly chart. There's not a lot happening here. We're stuck in a range. So that immediately tells me there's nothing to trade here. So you go down to the daily, it's just ping-ponging around. You go down to the 4 hour, it's just all over the place. It's incredibly choppy. Yes, it looks like it is setting up the bullish candle off a level of support, so it's probably going to work its way up here. So because it's so choppy on the higher time frame, I wouldn't expect the trend to just kick off and go now. Generally, when it's within a range, until it gets out of the range, it doesn't really trend. It just stays in the range. So therefore, you suddenly bring your targets and your stop losses are a lot tighter. It's not really the best type of stuff. You want something that's trending strong. It usually will keep running. It's a lot freer. It's usually a safer thing to type of thing to trade. So this is trying to set up with a bullish candle. It's gonna last an hour. That could be a potential setup from here to here. So it could be a potential day trade there to be taking. So that's that. Let's compare this with euro dollar. So euro dollar is trending a little bit better here on the weekly. It's a nice little area. Look at this uptrend here. It's coming back to the moving averages. This might produce a bullish weekly candle and then take off, which means that maybe there isn't a setup necessarily this week, but next week that could be trending beautifully. Hopefully that makes sense to you. So let's look at dollar yen. So dollar yen had a beautiful uptrend that it broke the trend. Now it's trying to push higher a little bit higher there. Let's have a look at that. It's also got, it's also here, you can see it's trying to change trend. So here's another example of one of those things where if I draw this down, you can see we've started to break through. Potential change in trend. We've got the lows coming in. They're changing. They get very spiky when the buyers start stepping in. They've broken above here. So there's a break above that high, a break and a retest. Bullish candle, enter above the high, stop loss there or stop loss there. Almost exactly the kind of thing that would happen in gold. It's almost exactly the same idea. I could wait for it to break above here. So that would be the equivalent of, so it's doing this, breaking, retesting and breaking there. If I wait for a break above there, it's the same thing. It's changing trend. So that looks interesting. So dollar yen, excuse me. What else we got here, guys? Let's have a look at cryptos. What's going on with cryptos? Okay, so there's a slight issue here with this. The weekly looks good. The weekly on crypto is good. It's a little bit of a consolidation and a breakout. It is very bullish. It's a little bit overextended on the monthly. Look, you can see it sort of go up here. That's ridiculous. That was a bubble. So let me show you how many bubbles they've had. That was a bubble. That was not really as much of a bubble, a little bit one. That was another bubble. That was another bubble. Why so many bubbles? Because it's new. It's like the Wild West. Also, there's a different type of person. Gamblers are very attracted to cryptos. Cryptos attract more gamblers than currencies do. Why? Well, because the swings are wild and so many other people have made money doing it. So many people have lost money. It is the Wild West. It's those people who have found gold. Those people haven't. It's a bit of a gold rush. And it's so young, it's still producing bubbles. In other words, it hasn't really settled into who it is, but also a large number of people engaging in it. More people are gambling on it than trading. Just be aware of that. There are traders trading it. There are potentially investors investing in it, but there are gamblers gambling on it. And gamblers tend not to. They would prefer to engage with cryptos over stocks, for example. In fact, they like the fact that it's the Wild West, that it's so new. So just be aware of that. So looking at it from a daily perspective, it's running out of steam a little bit here. The potentially might have a bit of a, if it falls back below this level, it might come back down to test this level here. Just a little bit overextended on the monthly time frame. Weekly looks okay, daily looks okay. Otherwise, if we get a really strong bullish candle here, it'll just keep going. So it's kind of one of those things where you want to wait to see what happens where it is right now. Let's have a look at US oil. US oil was very nice for me. US oil is trying to turn around. Okay, same kind of thing. It's starting to go bullish here. The MACD is climbing, so we've got higher highs. We've got it producing higher lows. It's trying to head up a little bit higher. We'll see. This is definitely one where I would wait to see probably wait for it to break here first, because the problem is it hasn't got a lot of buyers here. It needs, once it goes above a certain level, buyers jump in. Okay, it's kind of, think about a stock market goes to all-time highs, then people start getting in. So when it as the higher something goes, the more people start jumping in to buy it. The lower it goes, more people start going in to sell it. Your buyers, only your most experienced people get in earlier. So getting in early is a sign of experience potentially. Excuse me. And one last thing, let's have a look at the indices and then we'll wrap up. Let's have a look at the S&P. The S&P is just a beautiful index to monitor. It's 500 medium to large cap companies. They're all around the world. They're global. So if the S&P 500 is doing well, it's an indication of the global economy, okay, it's of the global health. So we've had a weekly correction now. If you look here, it's a beautiful weekly retracement. We're coming back into the moving averages. We're producing a bullish candle. How we close this week, if we close with a bullish candle here, then it becomes a high probability, especially if next week we break the high, we're going to keep going. I would like to see us have a deeper correction. So I would prefer for us to go from there down to here and then carry on. I would prefer that. And if that happens, great. But between now and April, we might see the markets just go. Seasonally, they tend to do that. So interesting. So basically, long story short, look at the indices. They might this week, if they finish bullishly, they might then just resume their uptrends after that. Again, a lot of them would have been better off having deeper corrections. But if we are in a really, really bullish environment, they're going to take off from next week. Ladies and gentlemen, that is it. So I want to say thank you very much for your time today. I really appreciate it. My name is Adam from Trade with Precision. And I would say that if you have any issues to do with the platform or your accounts, then please don't hesitate to get in touch with the lovely folks at Vantage Markets.